Let's kick off with Anglo American. Just heard from Tim Clark, mining analyst at Deutsche, that they've upgraded from a hold to buy. The stock has rallied 5% today, currently trading at 276 Rand. Your view on Anglo American?
Well, I think the news that the extracted deal or non-deal has been sorted out at least provides some clarity for investors. So that is a good sign. On the whole, we're a bit negative on the commodity stocks. We believe they've run way too hard and are too expensive. So across the board, we wouldn't be buying.
So it's not a view on Anglo American management not being able to unlock value. It's rather your view on commodities as a whole that is slightly negative.
100%. I mean, in that space, Billiton is still our preferred stock, but once again at much lower levels. So
are you watching this commodities rally with a wary eye, waiting for it to collapse?
Absolutely.
How far can we see it falling in your view?
Well, geez, tough to tell. Look, with all the inflationary stimulus that we've got out there, that is going to provide some kind of an underpin. But forecasting where it's going to go is pretty tough for, as value investors. What we prefer to do is sit and wait. If our price levels get there, we're happy to buy the assets. But trying to forecast exactly where it's going to go is
Let me put it another way. You are forecasting a potential crash on the commodities front, or is that a little bit severe? Am I putting words in your mouth now?
Yeah, maybe that is a little bit severe, but certainly relative to everything else, we don't find the prices particularly attractive.
Richemont also an upgrade out from Deutsche today, trading at 22.41 up 2.75%. Of course, we're attributing a lot to this Deutsche research note and then saying that they are almighty. What is your view on Richemont?
It's a good company. They've got a great set of assets, a great set of brands. A lot of that valuation is the growth that people are expecting in emerging markets. So given that we're marginally negative on the commodity front, maybe we should be marginally negative on emerging markets in general. So yes, I mean it is a good company. We wouldn't be buying it at these levels, but certainly the business itself is a great business, just not very attractive at this price level.
I refer again to Power Lunch on CNBC Africa. My colleagues debating with their studio guests whether you should be putting money into the international or local equity market. Your view on this debate?
We're much more positive on international stocks. We feel they provide much more attractive yields than local stocks with much lower commensurate risk. So the kind of stocks that we're buying internationally, you can buy stocks like Coca-Cola or Johnson & Johnson, absolute stalwarts of the world economy, at free cash flow yields of 5% and above, versus US government bonds sitting at around 3.5%, compared to stocks in South Africa, which are probably on a normalized basis yielding much lower than that and much higher inflationary environment. So looking at the government bond, our longer term government bonds sitting at sort of 8.5%. So on a relative basis, we're much more keen on accumulating international stocks. Having said that, the market has run pretty hard, so one should always be wary of that.
The Dow around that 10,000 point level.
Absolutely, but even with that run, we still believe that they are attractive. We were lucky to pick some of our stocks up in January, February, and then we will be buying in on any market weakness going forward. So there's a lot of really strong, really attractive companies at good prices.
Well, again, putting the US, for instance, into perspective, we hit an all-time high on the Dow on the 9th of October 2007. That was above the 14,600 point level, and stocks generally are still 30% off those all-time highs. Do you think that we can see that momentum coming back into that market, that additional 30%?
Absolutely. I think it's going to take a lot of time, and I think it's going to be very specific. So it's a stock picker's market. If we look at some of the results that came out last Friday, General Electric, which is one of our recommended companies, it beat on the bottom line, as we've seen quite often, but missed revenues by about 20%. We still believe that stock is attractively priced and have been accumulating it at lower levels.
Isn't the missing of revenues a concern for you, though? Because, I mean, the fact that the company is achieving profitability through cost cutting doesn't show that we've got top-line growth at all.
Absolutely, but I think the key here is that we're not expecting revenues to boost up straight away. We know there's a lot of trouble to come. The US consumer's under pressure. But even at those levels, we don't look at the last year's earnings or even the year before that. We calculate the sustainable earnings power of the company over 4, 5, 6, 7 years. And a company like GE, while it's going to be under pressure now, has a lot of great assets, and it'll sort out its problems at GE Capital. And it's
potentially looking cheap right now.
Absolutely.
Nic,